Hi, everyone. This is Ravi Chidambaram. I'm the founder and CEO of Rimm Sustainability. We are a tech and data platform that allows companies to adopt applications, solutions, and analytics in solving various ESG problems in their ecosystems. Asset managers are a very important part of our community. We're very happy to have you all on today. We're going to talk about the state of ESG, the current state of ESG in the asset management industry, which is very much at an inflection point, and where the industry may go in the coming months and years. I'm very lucky to have today with me two pioneers and trailblazers in the ESG investing space in asset management, Sasha Belik and Osamu Yamamoto. Gentlemen, welcome to the show, and thank you for joining. Let me please introduce each of you to our guests. Sasha is actually probably one of the founding fathers of the ESG investing space in public ESG investing. He had built a very sizable ESG investing business with Nordea in the Nordics, and is currently now the Chief Investment Officer of SIJ, which is a public equities ESG-focused fund out of Japan. Sasha also is an advisor to Rimm and has been helping us develop some cutting-edge data analytics. Dr. Yamamoto is from Unison Capital. He's a managing partner at Unison Capital. For those who don't know, Unison Capital is also a pioneer. They're pioneer first in the entire private equity industry in Japan and Korea. They were one of the very first PE funds in Japan. They've been highly successful with a 25-year track record. And separately, they've also been a pioneer in the ESG field and implementing ESG at Unison Capital and introducing ESG in the private equity industry in Japan. So, gentlemen, welcome. Again, great to have you on the show. Let's jump right into the various topics that we have today. What we'd like to cover today is the current state of ESG in the asset management industry, what's good, what's not, what's the issue. We'd then like to transition to how ESG could be improved across the entire spectrum of asset classes in the ESG industry. How is regulation playing a role or not playing a role in these reforms? We also want to talk about how technology and AI, the likes that we use at Rimm, could be transformational in the industry. And we'd like to finally close by talking about use cases and case studies and how these gentlemen are using ESG every day in their respective companies. So a lot to cover. We have about an hour. So again, thanks for joining us. So let's start first by perhaps asking a question to Sasha. Sasha, you are a pioneer in the public ESG investing space. In many ways, the entire ESG movement, one can say, without exaggeration, originated with ESG public equity fund managers such as yourself. They were, in fact, way ahead of the market, way ahead of companies, way ahead of other stakeholders in recognizing the importance of ESG and building a lot of proprietary tools to evaluate companies on ESG, including their own rating systems, benchmarking systems, and other analytics, and in many ways introduced the term ESG to the world. They had a great run for a long time as the fastest growing asset class in the world, until they hit a speed bump around COVID, and that speed bump seems to be now continuous. And in fact, I read today with some interest that many aforementioned ESG fund managers are even removing terms like ESG from their fund labels and the way they market to investors. And moreover, anti-ESG funds, such as the like of Vivek Ramaswamy's Strive Fund, are having a moment in that they seem to be on a roll, both in terms of assets coming into the fund as well as returns. So, Sasha, it's very fair to say that your industry is very much at an inflection point today. And I'd like to get your views on kind of how the industry evolved, and, maybe where it could be going.
Robbie, thank you very much for the invite. It's a pleasure to be here. And this is, of course, a very complex question. As you outline it in a very nice way, it is an inflection point. So if we start from the beginning, the ESG entire sort of approach related to ESG was to identify the value in the companies, which was not traditionally just financial value. So additional externality, the way how companies would address certain externalities, how the business valuation will then, based on that, be different, and how the investments will underpinning these valuations will generate some kind of a better performance or better returns over the long period. And the entire idea with ESG was to actually bring externalities into the valuation models, which is, if you look at it in a back mirror, that has been done. So it is part of the fabric of the investment industry today. So that's sort of one thing that ESG has accomplished. Now, the underlying sort of a driver with the ESG from the beginning, with externalities becoming a part of the fabric, was also to make these business models, to change the underlying business models, to get them more sustainable, to produce more sustainable products, to disclose information that will enable investors to see what's the sort of intersection between the financial growth and, let's say, climate issues or social issues and so on. Unfortunately, until now, many of the construct financial instruments out there in the world, which are deemed or labeled as ESG, have not been able to create any tangible, clear results with these kind of investments. So the businesses are still emitting a lot of CO2. The business models have not been changed. Most of the big ETFs and big ESG funds around the world are channeling money to tech companies, leaving out the big sort of a trench of the mid-sized companies around the world that would need capital and need to sort of change their business models. Without that, so the backlash is a bit expected. I've seen it all the way, sort of for a very long period of time, that this will come. I don't see the push in the US as a big thing. US market was originally and not really a big ESG market. It's more Europe. This is a European thing. And what you can see in Europe is that European Union is trying to protect itself a bit with the SFDR, Sustainable Financial Disclosure Regulation, and basically using the financial instruments, funds, investments, and so on, as a tool to increase the disclosure that the companies in Europe will do in relation to the climate impact they create. Now, when I say that, it's important to stress that regulation in European Union, which is the stringent regulation in the world, is only related to disclosure. It's not related to changing the underlying business model. And our industry, and I as a portfolio manager and investor, what I look for is the inflection where the financial performance of the company, how companies make money on ESG. What does ESG actually mean for them? And understanding that means that you need a completely different data approach and different analytics to understand these inflection points. And that's also one of the reasons why I think that the stuff that we're doing in Rimm, developing the new models and new ways to interact with the financial performance and the ESG, is actually creating much better insight and much better view on this.
Got it. A lot to unpack there, and we'll go into some of those in subsequent topics. But thanks for that intro, Sasha. Osamu, you are a pioneer in private equity in general in Japan, and you're a pioneer in introducing ESG to Unison Capital and your portfolio. Yet your industry and your peers in your industry in Japan and internationally are really laggards compared to the public ESG equity space. And that seems at first glance very strange, because you guys are primarily buyout oriented. You control your portfolio companies. You have an opportunity to engage with them in far more intensive and regular ways. And ESG externalities could impact due diligence and exit risk and so on. But yet so few of your peers are really adopting it to date globally. What makes you different, and what did you see that a lot of other people have not seen? And what does this really say about your industry?
Ravi, first of all, thank you very much for having me on this webinar. And it's a pleasure being with such a distinguished speaker like Sasha. on this very important topic. And with that, yeah, okay. So I'm not that pessimistic about our industry, my friend. Okay. So in the private equity, there are kind of a steps in terms of the ESG integration, how you implement the ESG integration. Okay. First step is, of course, your own firm. Okay. You start your own firm. And as a leader, what are you committed to in terms of ESG integration in your own firm? That should always be the starting point. Okay. So when we started back in '98, that time we didn't have a term coined like ESG, but we developed our guiding principle around two things. One is chasing financial return, but at the same time chasing the impact on society. Okay, so all the entrepreneurs like ourselves think in that way. Okay, in the private equity. But that's step one. Okay, step two is of course how you would like to implement ESG integration at a portfolio company's level. Okay, that's where Rimm comes in. And I have a lot of things to talk about, but I save that for later. Okay, that's a second step. So as a leader, and as you said, Ravi, we truly believe that private equity is the best form of implementing ESG integration to the portfolio company, simply because we are insiders. We know everything. Okay, and especially we are chasing a buyout strategy. That means we control the portfolio companies, right? So we are best positioned to really implement the ESG integration to the portfolio company level. But that's second step. Third step is industry level rulemaking and thought leadership. Okay, so step one, your firm. Step two, your own portfolio. What's step three? Of course, industry, right? And you're right. Private equity, even in the private industry, there are different camps on this issue, right? But I think it's in the transition. Okay, and in the midterm, we are going to see clearly the convergence of the views. Okay, for example, there's the initiative called ESG Data Convergence Initiative, or EDCI. Many of the participants have heard about it, but that was originally by Carlyle and Calvus. Okay, and their mission is to generate meaningful, performance-based, and comparable ESG data for the private equity industry. That started, 3-4 years ago, but now there are 350 GPs and LPs are in that initiative. That should tell you something, right? That's one. And two, at Unison Capital, we are originally from Japan. So throughout the Japan Private Equity Association, or JPEA, we helped them to set up a ESG committee. Okay, where many Japanese GPs operating in Japan. Okay, now working together, collecting ESG data, much like a EDCI initiative. Okay, so these are the kind of initiative that makes me smile. Okay, and that makes me very optimistic about the future of our industry. So I stop here, Ravi, and I get back to you.
No, that's a great introduction. Thank you, Osamu. And I think it's very enlightening for our listeners to hear about your waterfall approach and the 3 levels. As often, it always starts with the founders and then spreads through the portfolio and then to the industry. Yeah, so that's great stuff. Thank you. Let's move on. Sasha, I want to come back to you and talk about ESG 1.0 in public equities investing. What's good, what's worked, right? And what hasn't? How would you characterize the current state of play?
Well, I mean, the ESG 1.0, it's all about bringing the ESG externalities, issues that are relevant from valuation point of view for the companies into the realm of what company is. So into the valuation model. Now, putting the numbers on that, it's a completely different exercise. It's much more complicated to do that. Partly because the data is not sometimes comparable. Most of the ESG data is backwards looking, not forwards looking. Most of the data is maybe not covering today, as is it reported, is not covering products and services. It's actually covering what company as the entity is doing, not what their business is, which actually gives you this debate that was, the Exxon gets better ESG rating than Tesla, which sort of puts things into perspective. And this is the sort of the part that worked is that, okay, ESG is a part of valuation models. Fine, that worked. What it didn't work on is that how to link the ESG parameters, specific ones, with the products and the business model, products and services of the company. And how will ESG actually impact central gravity of the company to grow their business and to develop going forward? And this part is the one that is not working. What is also not working is that the most of the ESG data out there that is sold to asset managers and asset owners around the world is not regionally adjusted. It has very little local touch. It has a bias towards, if you take governance, if you take Japan, what Unison Capital is doing, which is a really, really good story. Governance, of course, for the private equity firm is very important. And the governance, if you look at the governance scores for Japanese companies, they are penalized because they view the board composition, longevity of the board members, and so on in a completely different light than it's viewed in a Anglo-Saxon world. So there is a lot of things that are in the current sort of ESG models not really working for the sake of the ESG as well, because ESG needs to move in that direction. What I think future will be about, and this is what I know that Rimm, and I've been involved in that work as well, is doing, is to see, okay, how is this linked to your products and services? How do they actually make money on this? Where are the things that you as a business can use to help you to grow business in a more sustainable way? That is the future of ESG. And of course, the more regional sort of adjustment of the ESG context, because operating in Southeast Asia and in Asia in general, with the particularities of energy mix and all of these things, will mean something else than if you're coming from the Nordic region.
Right. So just to summarize, I think it's fair to say that ESG 1.0, what they got right, was trying to introduce elements of ESG into securities valuation. However, local comparability, lack of data, standardization of data, has been plaguing that integration. Just before we move on to Osamu, I do have to touch on something that maybe it's a little bit controversial. In your view, if you're an ESG fund manager, explicitly or implicitly, right, is your duty to use ESG analytics to deliver higher alpha to your investors? Or in your view, you implied it should also have some kind of societal impact that's measurable. What's your view on that?
This is a very good question, because I think 99% of the products out there, ESG products, are process-driven products. So that's more to help you to, let's put it this way, where it works to help you to get better alpha out. Sort of, that's what you're looking for. Some of these things can actually lead to that. On the impact side, that you actually, what Osamu said, it said in terms of the creating impact, changing underlying models. That's so far just a couple of percent of the products in the world. So ESG so far has been process driven. It's ESG 0.0. Now 1.0 is it's all about impact. What impact, tangible impact you create.
Yep. Osamu, what does ESG 1.0 mean to you in the private equity industry and for Unison in particular? Does it mean certain milestones are achieved, data is collected, it's integrated into the way you manage your portfolio companies? What would be for you sort of the state of play of ESG 1.0 in private equity?
So ESG 1.0 in private equity is in my 3 steps model, step 1 and step 2. Okay, so you have to have a clear vision and a leadership at your own firm level, step 1, and step 2 is for you to be able, as an GP, you should be equipped with the some kind of mechanism that you can help for companies implement the ESG integration. That's ESG 1.0, my friend. Okay.
Right.
But there should be a 2.0 and a 3.0. All right. And that is maybe we can talk about that later in the webinar.
We will.
But you really can make a difference as a capitalist. Okay. And for us, 2.0 is to develop investment thesis. Okay. From the ESG ecosystem. And in order for you to do that, you need a new ecosystem. Okay.
Yep.
And that I can elaborate later. But to answer your simple question, what ESG 1.0 means to us, that's step 1 and step 2.
Understand. So just to summarize, it really means having an ESG governance mechanism at the fund, yes, where you set yourself certain fund level objectives. And then that translates into your portfolio. It yes, translates into collecting data and using that data to interpret performance and engage with your portfolio companies. Yes. So that would be, for you. Is it fair to say that many others in the private equity industry today, if we're still in 1.0, do they have a similar view, or does Unison have a unique view in that sense?
I think, like I said, that there's a convergence of the view. Okay, and that's because why? Because for what? We have investors. All right, and investors are putting a huge pressure on the GPs. On that
that's
side.
A great segue to my next question. So that's great. So let's move on. I want to talk about the role of regulation and how that's driving ESG adoption in the asset management industry and monitoring of the ESG element of the asset management industry. So I'll start with you, Sasha, again, and I'll say, you do a lot of investing in Europe as well, or you have done. Europe is, as you pointed out in the introduction, perhaps getting the most serious about introducing regulations for ESG funds and people who call themselves ESG funds with Articles 6, 8, and 9 under SFDR. But in your view, will this help reform some of the shortcomings in the ESG model, or can it be gamed, or is it perhaps defeating the purpose? What's your view on regulation?
It's a very good question. Thanks, Ravi. I mean, look, as I said, the EU is leading to sort of a regulation frameworks around the world. It's spearheading that. And the reason is that EU has developed EU taxonomy, which specifies within the taxonomy what's the sort of a sustainable climate is just one part of that taxonomy. There's another bits and pieces that should come into practice, but now that has been delayed for the various reasons. Social one in particular is interesting. That taxonomy has then transferred itself into a set of rules for companies to report on. And then, of course, on the other hand, on the other side, you have asset managers and asset owners who are now expected to report, disclose how their products are supporting basically EU taxonomy that way. So you can classify them that way. So I think that this is a first step. It's not a perfect solution. I think it's good that we are moving into the sort of a space that we are increasing the disclosure. But increasing disclosure not necessarily means that you're changing underlying business models. It actually means that you just say, but you disclose how it is, and you have some targets and some plans, but it's actually not forcing companies to change that. So the next step in this would be that you have the expectation of European Union is to have more and more Article 9 products, which are the impact ESG products, that will have objectives that are not only related to alpha, but are also related to the way how companies can improve their sort of ESG performance and create tangible results. So, I think it's a first step. I would, of course, like US to develop a similar regulation, so you have a harmonization. Japan, I know, is looking at the ways how to sort of mirror this in terms of getting somewhere between the Europe and the US to see exactly what would fit the Japanese market. But I think in general, in Europe, regulation is creating a big waves. on disclosure side. So that's the first step. Yeah.
Right. So it's fair to say that maybe incidences of mislabeling, greenwashing, and false claims around ESG practices will be curbed through this, but it doesn't still change the underlying model of how ESG is being applied in public equities investing. Yeah.
Yes, that's basically, that's a correct summary. Yeah.
Right. Osamu, I want to touch on a different kind of regulation with you. Of course, you also face regulatory pressures from the FSA in Japan and their increasing ESG disclosure requirements for asset managers, but I'm not interested in that. I'm actually interested in what you said, that the real pressure for you to become more ESG compliant are your LPs. It's a kind of a stakeholder pressure, if you will, that's kind of forcing you to regulate your behavior. Can you tell us more? Because you are a very global fund in the composition of your LPs, which is not typical in Japan. And you're exposed very much to the global trends, of fundraising and the ESG pressure that big LPs may be placing on these funds. Please elaborate.
Yeah, thanks, Ravi. First and foremost, we need actually for us to catch up regulatory framework. Okay, not just Japan, but you said that globally. We need external expertise. That's clear. Okay. Otherwise, it would be very difficult for us to follow the trend and understand our LP, where our LPs are coming from. Okay, but at the same time, Unison Capital, we have to admit that we are not a group of experts in the ESG regulatory framework and trend going forward. Once again, that's where Rimm comes in. Okay, for us, Rimm is not just a product. Rimm is kind of a research center or a think tank on ESG related matters for us. Okay, that helps. Okay, so you're asking, I told yes, there's a stakeholder pressure on us, but it's not a pressure. It's more like a collaboration, all right, on ESG integration. But having said, we have to understand as a GP, all right, where they're coming from the viewpoint of a regulatory framework, whether it's European LPs or whether it's US LP or whether it's APAC LP. In order for you to understand where they're coming from, you need the expert assistant. Okay,
Understand,
so that's my.
Yeah, no, thank you. But I think the audience may be interested to know, you're always out raising, new money, new funds. When you talk to the big pension funds, insurance firms, banks, strategic partners, are they, when they do their due diligence on Unison, do they also ask you many questions about your ESG policies?
It varies by the investor to investor, okay, but trend wise, there are significant increasing trend of them asking questions on this very important topic, which makes me also smile these days.
Yes, because that's where some of your good efforts and early efforts can really pay off. You may be better prepared than some other funds to answer some of those questions. Right.
Yeah. But,
very good.
We are doing this. Like I said briefly, we're doing this for our own sake. Okay.
I understand. So, it all starts with your top management and the founders and the beliefs. So we understand, because like you said, you started that long before anyone looked at ESG. So that's a very, very good point to make. Thank you. Let's move on. ESG 2.0. Sasha, what would that look like in your field of public equities ESG investing? And how can technology and AI, for example, even some of the tools that we've developed at Rimm, but also other tools that you see in the market. You know, where does this industry need to go from a data collection, data analytics point of view to make ESG investing more impactful?
I mean, I think that the you talked about conjunction, sort of a point where this is now we're sort of we're going into next stage. And the next stage is, I'm going back to my initial sort of a thing that I said, how do you make money on ESG? And this is what companies are struggling to show. And this is what investors are struggling to evaluate and put some money on it, in understanding what exactly does this mean. So the AI going forward and the ESG, the granularity of ESG data, but also forward-looking models where you can actually try to figure out, given what you know today, using the AI tools and models to see where the company is moving. And the core thing, which I've been looking for years, and that what I call true materiality, that's the module that the Rimm also has worked on to develop, is, okay, what if the company is to grow X amount % over the period of time, what does that actually mean in relation to their ESG targets and their goals? And how is this covered by the cost sector drivers? These are the sort of, if you're triangulating this going forward, and you try to find a way that you help asset managers to really see the true materiality, the true picture, that will shift a lot of money in the right direction. And Osamu is also very positive, and I'm positive as well, because I think in the next stage of this development, there will be far more, this is what is on the table, far more realistic than it has been so far.
Understand. So you're saying the real crux of the matter, right, is integrating ESG externality analysis with financial analysis to probably present the truest view of how ESG is impacting the everyday business of companies around the world. And fundamentally, as an asset manager, that's the way you have to evaluate companies.
Exactly. And that's not the case how it's done today, because what you have today, you have companies saying they have integrated reports, but financials and the ESG targets are not interlinked with each other, which actually makes them obsolete. Then you talk to the CFO, they have no idea. They haven't been involved in sustainability reporting. They even don't know about it. So this is what needs to change. Yeah.
Yeah. And it seems to me that even fund managers, they work with a financial set of metrics and a financial rating, and then they work with an ESG set of metrics and an ESG rating, sometimes provided by third parties like MSCI and so on. But they can't reconcile the two. And fundamentally, that is one of the problems in the industry. Is that a correct perception?
That's a very correct perception. And what I can say, which makes me still very surprised, is that in any ESG report produced by any of these big firms around the world, there is not a single financial metric in any of these reports. I mean, they are supposed to be used for investment decisions, but there is no financial metrics in them. It's two completely separated worlds. And this is what I think, what you guys at Rimm are doing, and what these modules are developing, the new sort of a true materiality approach and 360 climate and all of these new things that we are looking at, is going right straight into that sort of a space. We want to find the link between this. Yeah.
Yeah, it's the more granular detail on the most material topics, quantifying that into the balance sheet, income statement, and so on. Yeah,
yes.
Understand.
Yes.
Osamu, private equity, ESG 2.0, what would that mean to you?
In short, developing new investment thesis. Okay, and make a huge financial return out of that. That's ESG 2.0. That's very clear. And let me tell you why. Okay. So, I'm listening to Sasha's, description of what CFO of the big corporation, listed corporation are doing. I cannot help but think that they are doing such a boring business. In private equity arena, there are new trends, okay, new entrepreneurs, all right, and new financiers. They're really serious about this ESG integration, and they're also very serious about making transformational investment in the private equity arena to get a huge alpha. And Ravi, let me tell you where that alpha coming from. Okay. And in the outset of this webinar, you guys keep using the word externality. And externality, in order for us, like a private capital like us, to be part of that, resolving that externality, there should be one economic party who should be active and very thoughtful about setting up the framework, which is government. Okay, so in this private equity arena in the Indo-Pacific region, I am very, very positive about level of their understanding of the central government. I mean, all right, in this region, more or less, are now increasingly understanding what they should be doing in order for them to attract private capital like us, private players like us. Okay, that is really a huge economic incentive for the people like us. So it's a first mover advantage. All right, if you move first, you can get a huge alpha. And in order for you to be able to move fast, you have to be recognized as an ESG player, having having step 1 and step 2 already implemented at your firm level. Okay, that's a logic. So there's nothing sentimental about this part. It's a pure business, my friend, in our view, and that's ESG 2.0, my friend.
Yeah, no, that's a very good summary. Thank you, Osamu. So, but just to paraphrase, you said something very interesting. So a lot of ESG 2.0 is seeking out opportunities where the business model itself really is transformational, using ESG and impact principles to completely deliver different outcomes. So, for example, you may invest in a materials company that's transitioning to green materials entirely, and that could revolutionize their sales and growth trajectory, and at the same time do good for the environment, right? Or a company in Japan that's backing female workforce and entrepreneurship in a business where female workforce and entrepreneurship is critical to success. So it's kind of almost like backing transformation stories and putting capital behind it. So it's more in the investment thesis rather than, say, in Sasha's case, where he has to work with an existing universe and maybe look more at fundamental ESG financial integration.
It's a big difference. I'm envious. I'm envious a bit to Sam in terms of the opportunity, because look, on the listed equity side, you have the models are set, the structures are in place, so it's the way to maneuver. It's not that big because these companies have expectations, a lot of shareholders, and so on. Private equity space is indeed the one that you can make these things happen much faster, and I agree to that.
Yeah, very interesting. I think, however, in the ESG 2.0 world in private equity, the impact analytics will become very important, and the ability to quantify what that materials company did in terms of emissions reduction, right? Or the GDP impact or human resource impact of hiring more women. All those things, are things that probably PE firms will be held to account going forward. But anyway, we don't have to touch on that. So now I want to talk a little bit about use cases and how you gentlemen, have used tech, AI type models, to improve your own approach to ESG, in your respective portfolios. Maybe we can start, with Sasha. Can you give us an example of an analytic that you developed yourself or a third-party analytic that has really kind of improved your whole approach, to ESG investing?
I mean, over the years, I've developed this approach, which is related to central gravity of the business. We call it central gravity because every business is circulated around the axis. What is the axis, and what are the sort of key product, key client segments, and all of that? But also, what are the key ESG pools of value they can actually bring into that? So AI generated in terms of having enough data. So now the AI is developing. The more data we get, the more accuracy we will have. So when I did this way back, it was initial sort of a process where we could see much closer on the business model and on the products and services where the value is. But now with the new methodologies that we are developing at Rimm with true materiality, and we have this 360 model that is looking at the way of how fast sort of a forward-looking model on estimation and scenarios, becoming better. I'm already using that and will use that in a portfolio management I'm running in Japan, which will enable us to have a much better, I call it a true things on the table things, that we actually see how it looks. And then we can engage with companies and see what we as investors can do. And maybe pick companies that are much more better positioned to develop and leverage than the others that we have. It's almost, Ravi, like having a new pair of glasses, you know, when you're older like we are, and you get a much better view. Yeah.
Yes, well said. Thank you, Sasha. Osamu, you've been kindly working with Rimm now for some time, and we'd love to hear more about your experience using the Rimm Manage Plus platform and how that's helped you drive some of your ESG goals.
Yeah, before I answer that part, okay, in the long run, the big GP will have a huge appetite to acquire the tech platform like you for very clear reason that you just laid out, okay? In the next 5 years, 10 years, the a war for technology and a war for improving the productivity by utilizing the technology like AI, etc. You just mentioned should be the heart of our issue. GPs, normally don't have that kind of capability in-house. Therefore, they have two options. Continue to invest, and nurture their in-house capability, or M&A, right? So that's the kind of a vision that I have. And with that, let me explain, our experience with Rimm. Okay, so Unison has been actually involved in Rimm since its inception. We're lucky. We got to know you very early, right? And we've got a great vision, great leader, and a great team. We liked it. We're entrepreneurs, so we ourselves. So we have a kind of a very strong passion to work with entrepreneurs like yourself. Okay. Then as for Manage Plus, Rimm and Unison has been collaborating for more than 2 years now. Okay. And in 2022, we took Unison Capital took a major step forward by rolling out Manage Plus assessment to all of our 12 portfolio companies. That's step 2 of our portfolio ESG integration, portfolio company level ESG integration. And based on that result of the assessment and the feedback from Rimm, we now understand the current status of each company and are working to design next steps, right, to ensure more progress. So we're, in summary, we are very proud of the result of the multi-year project that we've been collaborating with you, right? And from identifying the materiality that you guys are talking about, or each portfolio company's relevant industry, obtaining feedback based on competitive benchmark, and providing actionable guidance as a GP, all right, on the measures that each portfolio company can and should take. So that's Rimm and a Manage Plus for us. Okay,
great.
But my future vision is the one that I laid out in the outset of my statement. Okay.
Yeah, no, thank you. That's a bold vision indeed. And, we need to work to live up to your aspirations. But just to summarize for the audience, really how you've used Rimm and Manage Plus is to help you establish what ESG topics at your portfolio companies are important to report on, how to collect data around those topics, how to interpret results coming from that data collection, and then using that as a tool for engagement and improvement in managing ESG risks and opportunities in your ecosystem. So, that's fantastic. And I hope that leads to good results for your portfolio in terms of exits and how companies do diligence and their overall equity stories. So we shall see. Gentlemen, I'd like to close this discussion today by talking about maybe, a somewhat controversial topic. So there's this notion that the fund managers have. There are ESG funds, non-ESG funds, and so on. And there seems to be this distinction, right, across many asset classes, right? But yet, I'm wondering, is this a false distinction? That there's really no such thing as an ESG fund, and there's no such thing as a non-ESG fund, regardless of if it's a private equity fund or a public ESG fund or public equities fund, and so on. In reality, could it really be just the case that there's no great mystery at all to ESG investing? Good investing means that externalities associated with all kinds of things, including ESG, will be paid attention to by asset managers, will be managed, will be quantified, and will just be a normal part of investment analysis and portfolio management. So that this distinction that we draw on today is an artificial one. Sasha, your views?
I would say that you're quite right when you describe it, because there are different, I mean, financial instruments, public equity funds or fixed income funds or whatever, there are different shades of, you know, different shades of what they are and what they could be, depending on the investment strategy you have. Some are thematic, some are bottom up, some are quant. They depend. I mean, it's so many different financial instruments. So yes, I think in the end of the story, it's up to investor to use the tools and understanding and knowledge to really understand what will that make that investment in excel, leverage on that knowledge, being that, you know, we talk about labels, maybe ESG will be transferred into XXX, doesn't matter, because what matters is the case in point is that the climate impact on disruption of global supply chains is costing companies money. So what does it mean when you invest? How do you actually avoid that, risk manage that? And also, how do you make money on that? So future, in many cases, will be that providers like Rimm and some other probably around the world will be able to provide us, you know, with the forward-looking things on which semiconductor company in the world is the fastest one coming with a, you know, most climate-friendly semiconductor production in the world. And that is the one that we want to invest in. So these are the things that will change going forward. And this is a very good thing.
Right. So basically, we still need to pay attention to the ESG tag in a way, is what you're saying, because maybe the winners amongst the asset managers are those who do employ more advanced ESG screens and analytics to ferret out companies at the inflection point of change in their industries, and they're the winners. And maybe that's a good way of coming over to you, Osamu, because you may disagree with my provocation by saying, wait a minute, in private equity, there's a hell of a lot of capital waiting to be employed in transition stories and themes. And we, as asset owners, right, can drive this transition. So impact, really is a key part of ESG, and we are really creating that impact through these transition themes.
Yeah. So so now that discussion about our discussion about ESG 1.0 and ESG 2.0 in private equity really plays here. Okay. So as we discussed today, if you are the GP in the private equity arena, there's no escape from ESG 1.0, period. Okay, so that's why some people hate this, because they hate, the burdens, right? They hate this as they see this as a cost, not as an opportunity, right? But sorry guys, it's done. All right. So in 5 years' time, if you are not compliant with the ESG 1.0, you're out of business. That's for sure, right? But you are asking far more, kind of a insightful question. That means, all right, what is ESG 2.0? All right, in my definition, that is searching for the new investment seed, all right, and creating a huge alpha as an investor. But my friend, it's just, your choice. Okay, roughly speaking, there are two camps. One camp is us, we firmly believe that making ESG 1.0 kind of a platform is really an investment, long-term investment. To do what? To make a lot of impact as well as a financial return from investment that we are going to make for next 10 to 15 years. That's one camp. Second camp is forget about it. Okay, Osamu-san, forget about it. ESG 1.0 is just a cost. So it's of doing business, we comply, but we have nothing to do with finding the ESG integration related investment theme going forward. That's entirely up to them, right?
Yeah.
And like any other investment thesis, there's no right answer. Okay, all you can do is make your choice and commit to that choice and make a great team around that. That's it, right? So that's my view. Okay.
No,
so,
very well said.
I hope I'm making sense to you. You are a very insightful question, but that's my view on the private equity side.
No, that's a very insightful answer. No, thank you. Thanks to both of you on that. So I think with that, we're coming to the end of the program, the webinar. However, I really wanted to turn it over to both of you for closing remarks and summary. So Sasha, perhaps I'll start with you.
No, look, I think thank you very much for the invite. Pleasure to be here with you and Osamu on this, and a lot of interesting discussion. I think the future we are heading towards is becoming more complex. Geopolitics, social pressures, inequality, but also on the other hand, a lot of opportunities, a lot of business models that are shifting, a lot of sectors that are basically changing entire sort of a level playing field where they operate, a lot of opportunities. Whatever we can do to make a tangible impact in that space will mean a very, very good financial return. Now, it's not a casino. In casino, you don't know. There's a chance. Of course, the chance is in all the kinds of investments that you do. But I think better understanding of the complexity, which Rimm, in many cases, through the services you have, enable asset managers, enables us asset managers on the other side to get better view. And better view means, at the end, hopefully, choices that we make, as Osamu said, that will lead to better returns. Yeah.
Great. Well said. Osamu, concluding remarks.
Yeah, thank you, Ravi. First of all, once again, it's a tremendous pleasure and honor to be sitting down together with you guys and discuss various very important and insightful topics. Okay, and my concluding remarks is the following. Like I said, you have a choice, but we made our choice already, and that means what? We need like-minded investor and like-minded friends like you, Ravi. Okay, like you, Rimm. Okay, so if you decided to find a way to create a huge alpha out of ESG integration data themes, you need an ecosystem, whole new ecosystem. That's what excites me. All right, because that's the kind of ecosystem nobody has ever seen. And we are committed to build that, and it's a long-term game, right? It's not gonna be like 1 year, 2 years, 3 years kind of thing. It's more like 10 to 20 years kind of thing. All right. Yep. But I'm so excited, all right, to see the like-minded people like yourself, Sasha and Ravi. At least there are 3 of us, okay? So we should be working together. That's it.
Yeah, no, that's a fantastic concluding comment, Osamu, because I think our audience will agree. ESG is a young and evolving field, right? As we found out today, there are many imperfections in the ESG investing industry. There's a trial and error process. There's a lot of excitement, but there's also skepticism. And the reality is that we're figuring out a lot of things, and the beauty that I've seen really in the ESG community is the willingness to share information, to critique each other, to force each other to be better, to learn more, to improve. So in that sense, I think we're in good hands in terms of where the industry can go, because I think there are a lot of amazing contributors who really want to do this because they want to do this and they do want to create impact. And they also want to build successful businesses. And, that's one of the things about this industry that you don't find in many industries, where information sharing and community building, may be more difficult to find. So on that note, let me conclude, today's webinar. I thank you both enormously for your time and contributions. Great to have you on, and thanks for your perspectives. Thanks to all the listeners today for joining. I hope you found the show interesting. And, we'll continue this webinar series with Rimm going forward and have some other great speakers and other great topics. But thanks very much, Osamu, Sasha.
Thank you very much. Thanks. Have a nice day. Thank you.
Thank you. Good day, everyone.
Please, thank you, Sasha. Bye,
Thank
everybody.
you, Osamu. Bye.
Bye.